one thing I've been thinking a lot more lately is, and actually we had one of our listeners and good friends of the show, Mark, gave us a little feedback last week that, at terminal or steady state, perhaps the way to think about Bitcoin increasing in value is not in relationship to GDP growth, which is a measure of flows, but in capital stock growth, which is a measure of stock. So in thinking about, if you take all of the world's capital assets and you denominate that in Bitcoin, however much those capital assets increase over time, that's going to be the sort of rate of growth of Bitcoin. Let's just say, for the sake of sakes, that's 4%. Maybe it's 2%, maybe it's 10%, whatever. It's some percentage. And that will change over time as well based on technology. But if we say it's 4%, in that new Bitcoin standard world, the new hurdle rate is 4%. So if I'm the carpenter or whatever I am, and I'm doing an honest job and I'm stacking, my Bitcoin, then
I like how you said that.
I know my audience. I'm stacking my Bitcoin.
Get punched from the side.
Exactly. I've caved to peer pressure here. Then I know that whatever I use that money for, I need to credibly believe I'm going to clear 4% return, because just the instrument and the capital instrument in which I'm saving is 4%. And so I think in that world, you're going to have a lot less debt, and the debt that does exist, it needs to have a really, really compelling use case that's going to pay back higher. And so I think you're going to see a lot more equity, which is shared upside in project that you believe could do better. And so I think what ends up shifting over time is you're going to see, the quality of projects that get undertaken or experiments that get run is going to be naturally higher, because there's going to be less just like crazy money out there. But I think you're also going to see a lot more in general, just like everything turns equity, or as much as possible, because in that world, you're sharing both upside and downside. Whereas in the current world, in the debt world, someone is trading that upside for perceived clarity or perceived certainty in what they're going to get. But obviously that perceived certainty is kind of like hand waved away because it's monopoly money. So yeah, I think we're just going to see a lot more equity. And to your point, if I'm investing in your company, and then this is what I think about all the time, and even for my fund, right? Because I have LPs ask me all the time, like, are you going to beat the Bitcoin hurdle rate? And the short answer is, I don't know. I mean, beating the Bitcoin hurdle rate, if we think it's going to grow many orders of magnitude for an entire fund, it's a very tricky enterprise. I actually don't think hardly any asset class or any venture capital fund is going to beat that over time. There will be exceptions, but to have that exception, and this is kind of what I explained to people. One, everyone's already kind of on board with the thesis. So they're already, sort of down for the cause, which is good. It increases the holding of stacks. There's a lot of reasons to do it, but is that we still have that outlier potential of, okay, if everything converts to a Bitcoin standard, there will be new Googles and there will be new really, really large companies built. And if we hit one of those, then we can outperform. But it's a much higher bar. You have to really believe this thing could get very successful.
But so I don't think you've said it directly, but a concern that I've heard, and maybe we've talked about before, is with a loose money policy, there's just lots of funding in Silicon Valley.
Yeah.
And, one can argue that's kind of wasteful, but it also gives a lot of talented people room to come up with the next Google.
Yeah.
And so if we have a money that in a system that doesn't really result in that, is that going to slow down innovation? I'm not too worried about that though, because in parallel with this, if we just look at over time, back in like the 80s and 90s, the venture capital world was like, took 6 to 18 months to just vet a startup,
right,
to even make an investment. And then the investment was usually quite large because the team needed a lot of money to actually build whatever they were building,
right?
Be it hardware or software. And obviously as time's gone on, now you can build applications extremely quickly. Now we're in a world where anyone can build an application extremely easily and quickly at no cost.
Yep.
So an individual person can cycle through hundreds of ideas in a short period of time. So I think we're going to see product market fit discovered much more quickly. You don't need investment. And as an entrepreneur, you would not want investment, because why would you give up equity in your in your startup when you don't really need to? Then once you have product market fit, well, then you might need capital to do marketing or hire people or what have you. But at that point, you're in a stronger position, and as an investor, you have more confidence in clearing that hurdle rate. at that maturity level for the startup. So I think these two will can coincide with each other, and it won't stunt innovation.
Yeah, I mean, I think there's a bunch of headwinds and tailwinds to all of this, and I'm a fan of kind of the Bitcoin standard future that I think we're contemplating, but I also don't know that I would see equity ownership versus debt ownership as like equity good, debt bad. I think they're just different tools that have different risk profiles and different trade-offs, and like we'd like to get out of the fiat systems that have a lot of corruption and how the money gets printed, how it gets allocated, who's close to the money printer and stuff. So I think I'm on board with the idea of let's reinvent, but I don't know that equity versus debt is necessarily like such a strong distinction to make, and sort of certainly to not imply a value judgment on one of them in the current situation. Like if you want to build something today, you kind of have to build a little bit in the current situation, or a little bit towards the future. I think about some of the kinds of, like you mentioned, well, how cheap it is to build something. I was actually, my neighbor was just showing me. Do you know what WebVan is? I'm going to ask the little kid
Of course.
first.
Okay.
Yeah. So WebVan is basically Instacart, right? But it was done.
But 10 years too early.
Yeah, maybe 15
years too early.
Maybe even 20. Yeah, but definitely way too early. But like the idea worked.
Yeah.
And the idea is worth a ton, and we use it, several times a week now. There was the early Instacart thing has some of the footage filmed here in the Presidio.
Oh.
But I thought it was interesting that's, it's 15, 20 year delay. And I think probably the original, WebVan was, I don't know, probably $50 million, which was big back in the day. And Instacart was probably basically built for kind of nothing, web app or a mobile app, get it going. And then it used capital to scale.
Right.
And so, I think that trend line is not stopped. That is continuing. So being able to use LLMs as a tool to help build the next software product, I think you're going to get tons of traction before you need it. So you might be able to actually skip, at some future point, you might be able to skip equity investment and use something more of a debt-like instrument because you're trading it off against future cash flows that you're already generating.
Mm-hmm.
All that is not to say that debt is good or equity is bad or anything. It's just, these are just different tools, I think.
So what you're saying, Mark Andreessen said the last job standing was venture capital. What you're saying is it's the first to go.
Well, I think in certain cases, like if your main job is to allocate to like 2 people in a garage, that probably doesn't work at massive scale as well 10 years from now as it has 10 years ago.
So all of us as early stage investors, we need to find a new
It's been real, guys.